Thank you, Monica, and thank you very much for inviting me to talk at your event. It's very good to be here with all of you, and I'm going to talk about a number of things, three things in particular. The scale and urgency of the challenges of COVID, climate change and biodiversity loss. I'm going to talk about the response from institutional investors in the past and now. And I'm going to talk also about the opportunity for institutional investors that I see emerging from the current drive towards sustainable finance. So firstly, the scale and urgency of the challenge. I think we all know that the COVID pandemic has been an enormous shock to the global system. It has exacerbated poverty and inequality. It's estimated by the NGO Oxfam that at least 500 million people will have been pushed back into poverty. So I'm going to continue talking about the scale and urgency of the challenge. As I mentioned, COVID-19 has caused enormous inequalities and increased poverty across the world. And more than 30 years ago, we knew also about climate change. We knew that there would be problems identified from climate change and from biodiversity loss throughout the whole of the world. And the Global World Economic Forum talked about these risks as fundamental parts of what needed to be addressed. 30 years ago, the Intergovernmental Panel on Climate Change set up was set up to try and advise governments on how to address climate change. Equally, biodiversity loss has been an issue for a very long time. We've had the World Wildlife Fund identifying that since 1970, we've lost 60% of species. So we know these are massive global challenges which we have to address. If we've known about them so long, and even COVID was the pandemic risk has been known for a very long time, how haven't we been able to drive capital towards better solutions to these challenges? And why hasn't institutional investment really been able to respond by driving that capital in the right direction? And I think there are a number of answers to that. I'm going to offer four. I think that number one, I think that there has been a sense that the efficient markets hypothesis has been something which people can rely on. The idea that we can retain faith in the markets driving capital in the right direction, that the market would deliver technological solutions when required. That has shown to be untrue, and I think it's something which is now much more recognition of now. Secondly, perhaps the science didn't appear as strongly as it does now, or perhaps we were just hoping that there would be solutions that we didn't have to take drastic action. Thirdly, I think importantly, asset owners deferred to fund managers in some ways. So there was a sense that fund managers know best, that there was a sense that somehow that we should rely on fund managers to manage our money in the most efficient way that would deliver the best results for society and for us. And then fourthly, I think critically, there was a sense that capital was flowing to unsustainable activities because we could make financial returns from that. It was quite possible to make good returns from unsustainable activities because the cost and the damage that was being done was not being held, not being accounted for by the companies or by the investors in those companies. So in the jargon, the social and environmental costs were effectively externalities. And since investing in these activities was perfectly legal, it was almost aligned with the fiduciary duty that one had to maximize the profits from those externalities. In fact, it could have been seen as failing a client if your financial performance was below that of a less scrupulous competitor in some ways. So I and many others thought that the financial crisis of 2008 might change that. We felt that people working in the finance sector at that point were making private gains, which were then having to be paid for by the taxpayer, and there were public losses. And we thought that perhaps there would be more of a recognition that the market failures were in place. And at the same time, we thought that perhaps climate change, which of course is the biggest market failure, would be addressed and by recognizing that the markets were no longer really working in our favor. So it didn't. That was 13 years ago. The 2008 financial crisis didn't make that change. But fast forward 13 years, and I think we now have a very different landscape, and I'll explain why. I think the scope for institutional investors to pursue sustainable finance is very, very different. So firstly, the science is very clear. So both on climate change, on biodiversity loss, the physical risks of climate change have obviously become very clear. Some assets are uninsurable. The need to move towards net zero by 2050 is clear to avoid irreversible climate change. And we know now that means we have to halve climate change or halve emissions by 2030. So there's an immediate need now. And the evidence of biodiversity loss, of the impact of plastic waste, of inequalities is evident all around us, and perhaps more so than it's ever been before. And we're listening more than we ever have before. But secondly, I think crucially obviously for institutional investors, governments around the world have started to legislate and to intervene to correct market failures. And it feels like they are more serious this time. Many of you investors will recognize the times we had in the 2010s where governments were intervening on renewable energy technologies, for example, providing subsidies and then taking them away again very quickly. We've now got a much more predictable, I think, much more solid response from governments on many of these issues. And thirdly, of course, technological changes have made lots of things more viable in the last 10 years. Only last week, the International Energy Agency said that it was not necessary to invest further in fossil fuel investments after this year. A big statement by an organisation that's not particularly seen to be progressive. So the fourth area of the four that I wanted to highlight, though, which I think is so critical to our conversation today, is that I think individuals and asset owners are asking more questions of fund managers about how they are responding to these challenges. And they're asking not just because they think there's a risk to financial return, but also because what's the point of having a lot of money in a planet that's not habitable? So I think for institutional investors, the game has completely changed. And I want to just talk about how I see those responses in institutional investors and what those responses currently are. So I'd like to visualize it as a kind of an onion. So the first layer of the onion, if we think about that being all of the institutional investments under management, then within that we'd have the ESG providers. Within that, I'm going to characterize a group that I call the target setters. And then within that, people who are transition seekers. And then in the core of my onion, I'm going to talk about the people I'm going to call transformers, who I think are fundamental to moving towards a sustainable economy. So let me just unwrap that onion for you. So that outer layer of the onion, which is all of the assets under management, we have about $110 trillion, just more, of assets under management. The expectation for them is that they will now have to report on climate risk, probably nature-based risk coming shortly, and a number of other sustainable finance activities. So we know that the Task Force on Climate-Related Financial Disclosures has given disclosure requirements, and that's becoming mandatory in more places. So increasingly, even the outer layer of my onion, all institutional investors will have to report on a number of these things. But within the next layer, which I'll call the ESG providers, that's about estimated $40 trillion, and an enormous range of activities, an enormous range of strategies within that layer. So increasingly, people are asking for the description of ESG providers to be clearer. So people can either have a strategy, perhaps just to tilt their portfolio towards environmental and social issues. They might just have an engagement strategy, but they might be doing something more fundamental. But the new rules in the Sustainable Finance Disclosure Requirement, the SFDR, as you know, is trying to tease out what is your agenda in terms of your ESG strategy. And Article 8 and Article 9, some of you will be familiar with in the SFDR, is saying you need to explain what your objectives are in the ESG space. You can't just label yourself ESG and expect no questions to be asked. But I think within that ESG providers, we therefore have some more granular groups that we can think about. So the next layer of my onion being the target setters. And we're increasingly seeing ESG providers saying, well, we want to set targets, perhaps based on the science, but saying we need those targets to be linked, for example, to net zero by 2050. So we have about $37 trillion worth of assets that are signed up to the net asset owners disclosure. And those groups are trying to create targets that will drive their portfolios in the right direction. There might be things that are, and sometimes actually align to the Sustainable Development Goals as well, so another key target. But those investors are at least putting themselves out there as driving targets in the medium term. I think within that group, though, there's the transition seekers, and I'm going to call them another T, the transition seekers, who are very deliberately recognizing that there are routes that aren't clear to the transition to a sustainable economy at the moment. So they know that they have to ask some really difficult questions around, for example, what's the role of regenerative agriculture in driving towards a sustainable economy, a net zero economy? How long can we carry on investing in aviation, in unsustainable transport? What's the role for the importance of gender and women's empowerment in this transition? Many big questions that I think the transition seekers are actively engaging on through initiatives such as the Transition Pathway Initiative and through Climate Action 100+, for example. So they're doing some great things, but I think the nub of my onion, the center of my onion, where the transformers sit, is where the biggest opportunity for institutional investors lies. So within the transformers, you have people who recognize that the change in the direction of capital has to be very fundamental. And we're not going to get there unless we take a very deliberate and intentional approach to driving solutions. So within my transformers, you have investors who are saying, we can't carry on in the way we've done it normally. We have to allocate capital in different ways to, for example, finding solutions to some of the more difficult questions that we've been talking about, to places, geographies, perhaps the developing countries which need the capital the most, to more intractable issues, affordable housing, for example, to the new kinds of renewable transport. But those investors are looking at this in a very deliberate way. And they have to be prepared to perhaps go into more illiquid, more risky assets. They're not doing it because they have some sort of, well, they may be doing it for some of them, they may be doing it for particular reasons around what their investors are looking for, and that's certainly the case for some of the high net worth individuals. But for institutional investors, there's a really key reason for doing this, which is making sure the rest of the portfolio can be resilient into the future. So there's no point in carrying on business as usual and investment as usual if we haven't solved these very difficult problems. And as you know, the global the Global Impact Investors Network, GIN, exists to sort of explore what impact investment is doing. It's approximately $500 billion that is allocated to this impact investment. And impact investment can have a whole range of returns, from commercial returns through to low returns. But the point is that it's an important part of an overall portfolio to make that portfolio more resilient over time. And there's been some interesting work done, for example, by the UK's Impact Investing Institute, which has talked to many legal firms about the compatibility, the alignment of impact investing and fiduciary duty, for all the reasons that I've mentioned, that it is compatible with trying to make sure that your portfolio performs the best into the future. It's also just a couple of other things to mention. I think really importantly, this does align with a framework that the Impact Management Project has come up with, which is 3 categories of types of investment. So one is A, which is avoids harm. The second is B, which benefits stakeholders, which is sort of your best in class type of investments, the ones where investors are just slightly better than the norm, but they're not genuinely contributing solutions. C being the contribute to solutions category. And I think my argument here is that all of the transformers, the people who are allocating some of their portfolio to contributing to solutions, those type of investments, are the types of institutional investor that will really be able to enable us to respond to the challenges that we face. And you're going to hear in a minute from some investors who are very much living this practically, and so you'll really enjoy hearing their practical ways in which they are implementing this theory. So in conclusion, I wanted just to make 4 takeaways for you. The first, and I think this is not news, we're facing immense challenges, and climate change, biodiversity loss, increasing inequality are things that will damage us, not just from a social and environmental point of view, but will have an impact on the resilience of our portfolios. And they'll reach a tipping point at which they become irreversible. Second point, it's great to see institutional investors responding. And it's really great to see, although perhaps it could have happened 20 years ago, but great to see that drive towards ESG and the integration of ESG. We shouldn't be underestimating the importance of that. But I think crucially that, I would say, is not enough. So we need to be deliberately contributing to solutions, finding ways to allocate at least a part of our portfolios to these very intentional, impactful activities for the good of our investors. And then the final point is, I think that investors are demanding this, but we can be, as institutional investors, I think importantly, can find ways to communicate with investors about the importance of allocating capital in this way. So I think there's a lot more appetite amongst asset owners, both individual and institutional asset owners, to really engage with these issues. And there are some great products around, and more will be needed. But I think that communication with the investor around how to really allocate capital to these solutions is the exciting opportunity that all institutional investors should be embracing. So thank you very much indeed for listening, and I'm sure you'll enjoy the practical examples that you're just about to hear about.